I know this is a software stock, but that PE is really high. We're seeing a market cap of $47 billion. The PE, as I said, 75 right now. Earnings per share CAGR has actually been negative over a 5-year period, which is not great. They got low debt, which is good. We're seeing price performance that the company has really accelerated here. We're seeing $35 per share in 2011. This is up to $93 per share today. Solid, definitely seeing some growth, and we can look here at the advanced metrics. That gross margin is disgusting, 85%. You do not see that normally, but it's not translating as much down to their operating and net profit margin. It's still really good. 19% operating margin is good. Net profit margin is 13%. We're just seeing that they do have some significant costs when it comes to operations that take away some of that earning potential that they could generate otherwise. Return on equity below 10%. 10% is always the benchmark. Revenue growth, we're seeing 5%. Okay. Net profit growth actually negative. Shareholder equity 6%. Okay. Free cash flow growth 6%. Okay. Nothing crazy there. Debt to free cash flow also okay. But let's take a look at the financial report, see if we can see any further indications whether to make an investment or not. So we're seeing in 2015, they generated about $4.8 billion in revenue. From a 2013 standpoint, we're seeing $4 billion here. Net profit down here at $630 million 2015. This is up from $290 million just 2 years ago. So solid on a short-term basis. We're seeing good stuff there. Let's go back a few more years. In 2013, we're seeing $4 billion in revenue here. And then this is down actually from $4.2 billion in 2011. From a net profit standpoint, we're seeing about $300 million here. And this is down from $833 million. So a quick flip back and forth, we can see the most recent data here that revenue has really essentially stayed flat. A little bit of appreciation here, but nothing crazy over that period of time. And then net profit, we're seeing some improvement in the short run. But if you zoom out, you look back a few years, you're seeing where that negative growth rate is coming from, is they used to be generating about $800 million in profit. So the question I want to ask is, from 2013 up to 2014, what happened? Why were they only generating this much profit compared to what they were doing before? And why hasn't it returned to that level? That's a little bit concerning. It's still a profitable business, which is a good sign. But why is that growth stagnating, especially from a sales standpoint, but as well from that profitability standpoint? There are just some questions that are on my mind. If we go back even further, all the way to 2009, so essentially from 2009 to 2015, they have grown their revenue by about 33% overall. And that's fine, that's decent, but it's a slower growth rate than many of the businesses out there today. It's just a little bit concerning. The profit standpoint, you are seeing, again, consistent profitability, which is good, but it's just what happened? And this is a mystery stock, so I don't know the business, I don't know what's happening or what led to it, so I have to use my best judgment here. And it's just something to be more critical of more than anything and factor in while you're making this investment decision here. We are seeing from a net cash provided by operating activities, they were generating about $1.1 billion in 2009. Looking at today, it's about $1.5 billion. So again, some growth, but not a lot of growth. And I think based on the information that I've already captured here, I think I can make my determination whether to invest or not in this stock. Summarizing here, you are seeing a $4.7 billion market cap for a software company, a 75 PE, and the growth rates here are not exceptional, and net profit is actually contracting over that time. Their margins are healthy, decent enough, but because of that slower growth rate, I think that the business is probably overvalued. That 75 PE is not justified, because the only way a 75 PE is justified is if your earnings can accelerate up to a point that PE compresses. Otherwise, it's going to be from the stock depreciating in price. And for all those reasons, as well as this growth in the stock movement here, I think it's just best to pass on this stock. Let's see how I do. So some appreciation, the stock actually did grow by 167%. This is Adobe, which is a great business. It's just one of those situations that I don't like those high PEs. There's certainly opportunity to generate, and in this case, over that period, you would get about a 10% compounded annual growth rate, but I just think it makes sense to pass on a business like this at the time. Here, I'm obviously wrong in hindsight when you see that appreciation, but as I always say, you live another day, you move on, and you're gonna find more opportunities out there. Sometimes you just gotta take a pass, and that's what I did. Let me know what you think of my analysis. Where did I go wrong? Where did I go right? And what do you think of Adobe now? I'm actually a big fan of this business for the most part. There are some threats actually at this point about whether AI is going to jeopardize their moat, but Adobe's a great software platform for many reasons, and they have helped a lot of artists and creators generate content that exceeds what they could do otherwise. But let me know in the comments, and if you want to play Compoundo, go to compoundo.com for free and put your stock picking skills to the test.